Seng Index has had quite a ride in 2025. Kicking off the year, we saw a robust 15% surge in the first quarter, fueled by optimism around Chinese government policies aimed at boosting economic growth. The launch of DeepSeek also sparked excitement, driving a rally in AI-related stocks, particularly large-cap internet and software names. This momentum pushed the Hang Seng Index to a 3-year high in March, but then the market weakened significantly in April. On April 7th, the index plummeted 13% in a single day due to fears of escalating Sino-US trade tariffs. As trade tariffs de-escalated and the worst appeared to be discounted, the market bounced back with the Hang Seng Index climbing about 16% over the first 5 months of this year. So what's behind this resilience for the Hong Kong market? We believe strong fund flow is an important driver. Southbound fund flow remains very active, accounting for an increasing percentage of Hong Kong equity market turnover. We believe that global fund flow is also likely a contributing factor as investors seek to diversify from U.S. equities. Valuations are also supportive for such fund flow. We are seeing more A-share companies listing their H-shares in Hong Kong, diversifying the market beyond traditional sectors like financials and real estate. Some Hong Kong IPOs of A-share names saw strong performance, with H-shares trading on par or even at premium to their A-shares. On the macroeconomic front, uncertainty persists, particularly relating to concerns over the potential adverse impact from tariffs, progress of trade negotiations, risk of global recession, and U.S. Federal Reserve interest rate policy. There has been ongoing news flow relating to Sino-US trade and tariff negotiations. While we heard of some good progress from the U.S. side, particularly relating to Sino-US trade talk on rare earth magnets, there is a lack of details and completeness in any specific agreement announced by both parties. As such, at this stage, it is hard to assess any implications. Overall, some progress from trade talks is generally anticipated by the market, although it is uncertain whether there will be any significant advancement coming out in the short term. Regarding the trade data, May exports from China to the U.S. weakened significantly, despite the trade truce and the cut in the average U.S. tariff rate on imports from China from about 110% to about 41%. Following Sino-US Geneva talks in the early part of May this year, reasons for significant weak China exports to the U.S. in May include, firstly, despite the rollback in tariff, the increase in tariff is still very significant, and hence is likely to have some adverse impact on China exports to the U.S. Secondly, the impact from tariff de-escalation could lag behind, and therefore could be reflected in the coming couple of months. Another reason is that there has been a significant rise in shipping rates. Overall, China exports rose by about 5% year-on-year in May, helped by exports to non-US markets, which continued to be relatively resilient. Over the past few years, Chinese exporters have adopted various strategies in view of potential Sino-US trade war. These include building production facilities overseas and diversifying away from the US market. As Chinese manufacturers still generally have cost advantage over its global competitors, they are generally not too concerned about their market share loss due to tariff. However, indirect impact on demand with risk of global recession is a major concern. Overall, uncertainty over trade tariff will remain an overhang on the Hong Kong equity market. That said, we believe that the Chinese government will continue to provide fiscal and monetary support to the economy if necessary. In terms of U.S. interest rates, the impact is relatively higher for Hong Kong due to the peg exchange rate. For China, interest rates have decoupled from the U.S., and it is expected that interest rates in China will continue to trend lower gradually over time. While the timing of U.S. interest rate cuts is unclear depending on tariff situation, any U.S. interest rate cuts should be positive to Hong Kong property names. High dividend yield names will also benefit. As well, if U.S. interest rate cuts trigger U.S. dollar weakness and therefore Hong Kong dollar weakness, this will help to improve the competitiveness of Hong Kong's retail, tourism, and asset prices. On the basis that trade tariffs will not re-escalate again, then the upside of Hong Kong equities will partly depend on the progress of trade talks. That said, we believe that the Chinese government will continue to support economic growth to counter the impact of trade tariffs. Also, global investors will continue to look for diversification from U.S. assets, and therefore, Hong Kong-China equities will be amongst the beneficiaries. However, global recession and demand destruction is a major risk. Geopolitical concerns and tariff uncertainties will lead to more cautious corporate capital expenditure and consumer spending. So in terms of sectors, we will continue to favor structural growth areas, including companies benefiting from manufacturing upgrading and increasing localization, as well as AI-related thematics. So far, in 2025, the performance of the technology sector has been quite mixed. The reason for this mixed performance could be due to, we believe that there's still a lot of concerns over chip ban, which will inevitably slow down high-tech development in China. Although China has already increased their effort to drive innovation, self-sufficiency, and localization. Secondly, tariff concerns have undermined performance of smartphones supply chain and also the PC-related areas. Thirdly, potential demand weakness due to global macroeconomic concerns. Also, another concern is expectations that AI infrastructure build-out may slow down further out, for example, after 2026, as focus is likely to be shifted towards application. And finally, share price correction of AI thematics due to quite high valuations earlier. On the other hand, China biotech space has seen positive development of late. We have seen an increasing trend of China biotech companies licensing out their innovative drugs to multinational pharmaceutical companies. We believe that China has cost advantages and also scaled in R&D of innovative drugs. In the software space, China has been progressing well as, for instance, adoption of advanced driver assistance systems, ADAS, has been rising rapidly to cover not just the premium segment of EV, but also mass market models. In humanoid robotics, selective companies in the automobile component and manufacturing equipment space are leveraging their expertise in their core business to expand into this space with the hope to supply to Tier 1 customers. For the Hong Kong market, Sino-US tensions and geopolitical risk is nothing new. Over the past few years, Sino-US tension as well as regulatory tightening by the Chinese government on selective sectors have triggered market derating. We believe regulatory tightening by the Chinese government is mostly behind us. While geopolitical concerns persist, and at times could trigger market volatility, we do not expect significant and sustained impact on Hong Kong market. The market is likely to remain volatile. However, we believe that Hong Kong market has discounted a lot of negative news. Valuations are reasonable with relatively attractive dividend yield. Chinese companies are increasingly focusing on improving free cash flow with potential for deleveraging, raising dividend payout, and buying back their shares. Therefore, relative risk-reward is favorable, and we would recommend accumulating on share price weakness. Investors should monitor the following developments for potential opportunities. These developments include post-90-day truce on tariffs, potential U.S. Federal Reserve interest rate cut in the second half of this year, the U.S. dollar trend, as well as further supportive government policy from the Chinese government.